The central banks want you to suffer. Inflation won't go down if people don't feel massive pain in their everyday life and if people are not unable to buy and purchase goods they want or need. This is the hard reality and nobody seems to understand. But don't worry, I got you covered. Watch this video until the end and you will have no question marks left about inflation, interest rates, and how it affects your life. Now, enjoy this video, and if you like content like this, feel free to leave a like and subscribe to this channel so we can educate more people for free. Since March 2022, the Fed has raised interest rates aggressively to fight inflation. But what exactly are interest rates? Simply explained, interest rates dictate the price of borrowing money. If the interest rates are high, then borrowing money is expensive. If interest rates are low, then borrowing money is cheap and you will get a loan for very cheap money. This has an effect on any kind of loan. It can be a loan for a house, for a car you want to buy, your usual credit card purchases, or corporate loans for businesses who want to employ more people or scale their business. In 2020, the interest rates were cut close to zero to cope with the economic effects of the pandemic. The US government issued stimulus checks to millions of Americans. And this money needs to come from somewhere, right? Over the next 2 years, the US central bank has printed more money than ever before. Actually, more than 80% of all the US dollar in existence were printed in the past 2 years. Let that sink in. So it's not surprising that we need to fight with high inflation right now. Money was basically free for more than a year, and people and companies took advantage of that. And this is also the reason why all assets were skyrocketing. Stocks, commodities, and cryptocurrencies were all surging to new all-time highs in 2021. Most companies reported record sales numbers in 2021. This doesn't necessarily mean that their value was growing. It simply means that the US dollar was devalued by printing tons of new US dollars into the market. More money in the market means a higher inflation. Money is very cheap to borrow, so more people borrow money, and more money in the markets mean a higher inflation. So when money is cheap to borrow, there will be more money coming into the markets, and with more money in the markets, that equals high inflation rates. Eventually, the Fed realized that inflation is growing quickly, and they started raising the interest rates to fight the inflation. And this is exactly where we are now. We have a very high inflation rate, which the Fed tries to calm down by raising the interest rates very aggressively. In fact, it's the most aggressive rate hike since the early 1980s. So since more than 40 years, the Fed never went so aggressive on raising the interest rates like they did in the past year. By raising interest rates, the Fed makes money more expensive to borrow, which will effectively slow down the economy in the long run. But what exactly happens when the Fed raises the interest rates so aggressively? Let's take a look on that step by step. Step 1. If you want to buy a new house or a new car, this will get more expensive now because the loans have a much higher interest rate. So instead of paying 1% in interest, you now maybe pay 5% in interest per year for the loan you're taking out to buy a new house or a new car. So maybe this brings you to the decision not to buy this new home. Same goes to companies who would like to borrow money to create new jobs and to scale and expand their businesses. They will most probably stop doing that if the interest rates are too high, so they don't need to pay too high interests. Step 2. Companies can't create new jobs. And in fact, most companies are reducing their staff to keep their business alive during these times. This results in people losing their jobs and the unemployment rate to go up, which again slows down the economy and brings down inflation. Step number 3. So the cost of living is going up because of the inflation. And the cost of borrowing money is getting more expensive, so people have less money and things are more expensive. This results in declining sales in the luxury sector and unnecessary purchases in general. People are struggling to pay their rent, gas, electricity, and so on, and they have mostly no money left to invest in any luxury goods or unnecessary purchases. And this is exactly what I meant when I said the Fed wants you to suffer. It's part of the plan. You need to suffer to slow down the economy. If nobody suffers, the inflation cannot go down. If people are free to buy whatever they want and whatever they like, inflation will just continue to rise, and we will see it going into hyperinflation like we have seen in Venezuela, Argentina, or Turkey. We need to prevent hyperinflation at any cost. It is one of the most dangerous things that can happen to an economy. Step number 4. Now you have no money left to buy goods from companies. This results in decreasing profits and revenues for companies, which again results in companies forced to fire their staff and reduce their employees. Now more people struggle to find a new job and thus struggle to have money to buy anything they want. So more people get unemployed and they struggle to pay their usual bills like gas, electricity, and rent. And there is absolutely no money left to buy any kinds of luxury goods or to spend money in the markets. As you can see, this is a whole cycle. People have no money to spend, companies are earning less profits, companies need to make people unemployed, and unemployed people usually have no money. And this is a whole cycle which repeats itself multiple times. As soon as this pain is big enough, we will see prices slowly going down because the supply is greater than the demand, because people simply cannot afford the products. Prices going down will bring the inflation down as well, and this is exactly what the Fed is targeting currently. So, we know the plans of the Fed, and let's say they will become true. We will see the inflation going down towards the targeted 2% mark, and this is exactly the part where the Fed needs to start printing money again to prevent us from going into a deflation. Now you know exactly how interest rates work and what effect they have on everyone's lives. But how does this help you navigating through the markets? It's very simple. If interest rates go up, usually the price of assets go down. Knowing this can help you make better decisions when it comes to your investment portfolio. But keep in mind, every decision the Fed is announcing takes 6 to 12 months to really show its effect on the open market. And this is exactly why many experts, including me, expect to see a recession in 2023 as the result of the interest rate hikes of last year. So now you should have a pretty good overview of how interest rates work and how they affect your life. Additionally, this can help you a lot by making decisions about your trading or investment portfolio. Generally speaking, the rule is as follows. If there's a lot of money in the market, if new money gets printed a lot by the central banks, and this doesn't matter which central bank it is, then asset prices go up because this money needs to go somewhere. If there's a lot of money in the markets, people tend to invest much more into those assets. If there's not a lot of money in the markets, like right now, people tend to take out their investments to pay for their expenses. This is also one of the reasons why I currently don't trust the uptrend we are seeing in every market. The stock market is going up, the cryptocurrency market is going up, but the Fed's plan says the complete opposite. The Fed wants the markets to go down so people feel the pain. If you don't feel the pain because your doji investment is still paying for your expenses, then the Fed's plan can't become true. So the Fed wants that the markets are stumbling, that asset prices go down, that house prices go down. When prices go down, it usually means that there's more supply than demand. And the only thing the Fed currently wants is to bring the demand down, to slow down the economy, to reduce the inflation rate. Let us know in the comments down below what you think about this topic and if you think that the Fed's decisions are correct. If you learned something new, feel free to leave a like and subscribe to this channel so we can educate more people for free. See you in the next one. Peace.